Well, we've entered a new phase in the Canadian economy with the endgame of the Bank of Canada finally playing out, the same endgame that was planned way back in 2020. A new report predicted that next year Canadians will expect to pay $1,065 more to feed the average family, bringing the total amount up to $16,288 to feed an average family of four in Canada, making it all the more important to get inflation under control, which is exactly what the Bank of Canada is trying to do with the decision it made yesterday to boost interest rates up 50 basis points. But the whiplash that we're experiencing from going from historically low interest rates to historically high interest rates could have some negative impacts on the Canadian economy, leaving borrowers, especially borrowers with variable rates, on the brink. And while on the surface the Bank of Canada says it could be done raising rates at least for the next little while, because of their endgame plan, rates could continue to go up due to some accounting funny business that's going on behind the scenes. So let's get into the new details that have been released by the Bank of Canada, why the governor of the Bank of Canada's counterpart had to publicly apologize last week, and why some are saying that what the government is doing to try to help could actually just make things worse. So let's get right into it, and make sure to subscribe to the channel if you haven't already done so. Take a look at this report. It's directly from the Bank of Canada as of yesterday. They've increased their target for the overnight rate to 4.25%. What this is just saying is that they've increased interest rates by 0.5%. And there's another thing here to note that's important too. The bank is also continuing its policy of quantitative tightening, but we're going to get back to that because it is quite interesting. Now, we've already gone over the numerous impacts that raising interest rates can have on the Canadian economy on this channel, but as a quick recap, with higher rates, we could see larger unemployment down the road as businesses don't expand as quickly. Higher interest rates could mean more and more people hitting their trigger rates on their mortgages, the points where they're only paying interest on their mortgage instead of actually paying down the principal on the loan. That's called the trigger point. More and more folks hitting that, especially if they're on variable rate fixed payment mortgages. That's especially important for them to consider. And of course, this has an impact on home prices and home affordability. Always when interest rates go up, we see a decline in home prices. The general rule of thumb is for every percentage point that mortgages increase, well, housing prices should tend to decrease by 10%. And we're seeing that here. We've seen interest rates go up dramatically, and this blue line is the decrease in house prices. But what's interesting here is the yellow bars. We've talked about this on the channel before. That is home affordability, right? Even though home prices have gone down significantly in recent months, well, they're even less affordable because people have to pay more on their interest rates to get mortgages to purchase these homes, which is why we have a new article here from RBC that says Canada could be turning into a nation of renters because people just simply can't afford a home. Let me show you what I'm talking about. This study is called "Is Canada Becoming a Nation of Renters?" Like some parts of the EU are, with most of the population renting instead of owning their properties. And we can see based on these numbers that while things are starting to trend that way, we can see this graph here. The pale white or the pale blue bar is the amount of people renting at that age back in 2011, and the dark blue bar is the amount of people at that age who are renting in 2021. And we can see in every single age group we have more renters than previously. And we've seen that this rentership has increased far more quickly than home ownership in Canada since 2011, 8% increase in the amount of people that have owned their homes and a 22% increase in the amount of people who are renting their homes. You might say, hey, how come both of these numbers go up? Well, of course, we have a larger population now in Canada. So even though we have a higher rate in both areas, the overall proportion of people that are renting is increasing. And that's the percentages that we're seeing here in all of these graphs. So for people who were expecting to buy a home and were maybe even waiting for a downturn like this in order to purchase it, well, they're now not able to purchase it because interest rates are so high, right? So we have less people buying homes, more people becoming renters, and more people who would be buyers entering that rental market. But for the people who did buy at the top when interest rates were at a historic low, well, they're pretty frustrated by the Bank of Canada right now because the Bank of Canada indicated that interest rates would be low for a long time, and these people purchased the homes with that guidance, and now interest rates are skyrocketing at the fastest rate we've seen in recent memory. And this is actually what caused the Bank of Canada's counterpart in another country, in Australia, the head of the Reserve Bank of Australia, to actually come out and apologize for this very thing. Let me show you.
I'm sorry that people listened to what we'd said and acted on that and now find themselves in a position they don't want to be in, but at the time we thought it was the right thing to do, and I think looking back, we would have chosen different language.
They say, hey, we made a mistake telling you that interest rates would be low for a long time because of how fast interest rates are going up in Australia as well. And in fact, in Canada, we've seen mortgage rates go up by 250% from the lowest lows to the highs that we're currently experiencing, a 250% increase. So it's leading some people to say, hey, Bank of Canada, didn't you say something similar?
So we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time. Low interest rates make spending and investment more affordable, and spending and investment will support the recovery. That would be our message to Canadians.
So in order to get Canadians to go out and spend as much money as they could, the Bank of Canada lowered interest rates dramatically and said they're going to stay there for a long time, and essentially sacrificed people who made long-term debt purchases at these low interest rates, especially these people that are experiencing such a dramatic increase on their mortgages today. But unlike the Reserve Bank of Australia, we haven't seen any sort of apology for this dramatic forward guidance that was given back in July of 2020. But we've got rates flying up in the current environment, and it does seem that based on some certain language inside of this announcement that they're increasing rates by 50 basis points, well, that they might be stopping in the next little while. And the sentence I'm referring to is right here. Looking ahead, Governing Council, that's the group of people that make these decisions, will be considering whether the policy interest rate needs to rise further to bring supply and demand back into balance and to return inflation to target. Remember, they're targeting between 1% and 3%. That's their acceptable band of inflation. Now, this might not sound too revealing, but in central banker speak, it really is compared to what they've been historically saying in the past. Note, they say, we're going to be considering if these interest rate increases are even necessary anymore. In all previous reports, they had said we're going to decide how much interest rate hikes we're going to need in the future. We certainly are going to need to continue raising rates, but we're going to be thinking about how much. And now the question is not how much, but if. So that might be welcome news for many people who are hoping that interest rates go down in the future, or at the very least they don't increase anymore. But there's some interesting language here that you might have caught at the beginning. I pointed it out, and this could change things and even lead to interest rates continuing to rise, or certainly not decrease over the next little while. And that is that the bank is also continuing its policy of quantitative tightening. You might have heard of quantitative easing before, but the flip side of it, the end game, is quantitative tightening. To understand the Bank of Canada's end game, you have to first understand how they started their game, the quantitative easing that began. We've talked about it on the channel before, but as a quick refresher, I think this chart does a pretty good job of it. This shows how many Government of Canada bonds the Bank of Canada owns. You see, at the beginning of the pandemic, the Bank of Canada wanted to buy up a bunch of Government of Canada bonds for a couple of different reasons, the main one being to push interest rates down, because as you buy more bonds, the price goes up, and bonds have an inverse correlation between price and interest rates. All this just to say that by buying a bunch of bonds, the Bank of Canada suppressed interest rates even lower than they were able to when they were putting their interest rate at 0.25%. So they just wanted to stimulate the economy, put a whole bunch of new money into the economy to make sure that people kept on spending, kept on buying. And that's that period that you're seeing right here, the dramatic increase in Government of Canada bond purchases by the Bank of Canada. And actually, I think this chart does a very good job of explaining it too, and the different periods, right? We saw them claiming that they're restoring market function at the very beginning of this, making sure that people were going to keep on spending in the economy. And then you see this next period here claimed to be quantitative easing, where they're buying all of these Government of Canada bonds and providing liquidity to the market. And then we see two other phases here that are rather interesting: reinvestment phase, as well as the quantitative tightening phase. And I actually think I should probably move myself over here so that you can see this a little bit more clearly. Quantitative easing was when they were buying all of these bonds. At a certain point, they stopped buying new bonds, right? That's this line right here. And this reinvestment phase is saying, hey, when all of these bonds become due or they mature and we get our money back for the bonds that we had purchased, well, we're not going to just let those bonds roll off of our balance sheet. We're actually going to reinvest that in purchasing more bonds. And that's what you can see right here in this period between these two yellow lines, that's where the Bank of Canada was, some of these bonds were expiring, but they were just using that money to buy more bonds. And that takes us to the new phase of the Canadian economy that we're in today, quantitative tightening. This is the era that we're in now, and it's what the Bank of Canada actually pointed out in its chart right here, that they're going to continue quantitative tightening. So if quantitative easing pushed down interest rates, well, quantitative tightening is the inverse of that, so you might expect them to push up interest rates, and that's exactly what I think is going to happen here over the next little while. You see, the government, or the Bank of Canada now, is letting its bonds mature, and with the funds that it's getting as after that maturity, they're not repurchasing bonds, they're just letting that roll off their balance sheet. All of those bonds that they had owned before, the government of Canada will have to issue new bonds to pay off that debt, except the only difference between now and then was that previously they had the Bank of Canada to buy up all these bonds, but now there is nobody to buy all these new bonds that could be hitting the market. And we can see that here with the Bank of Canada and the reduction on their balance sheet of Government of Canada bonds. This downward trend is them letting these bonds roll off of their balance sheet, but there's nobody to buy these bonds, or at least there's not a big buyer like the Bank of Canada to buy these bonds. So it's likely that in order to get these bonds purchased, the purchase price of the bonds needs to go down. But you know what happens when bond prices go down? Well, the yield on those bonds goes up. That's that inverse relationship that we were talking about before. So this is an added pressure that could add more pressure to interest rates going up further in the future, even if the Bank of Canada doesn't actually change their base policy rate. Now, there is a chance that the Bank of Canada will be able to effectively slowly let these bonds roll off of their balance sheet, not having to sell any Government of Canada bonds and having less of an impact on the market. So the effect to which these interest rates are impacted, or the amount to which they're impacted, is up for debate. And I'm curious what you think about it. What do you think about all of this, the impacts of the half a point or half a percentage point raise that we saw just yesterday, and the impact of that on housing prices, the higher cost of living with that grocery report? What do you think about all of this? Do you think we're on the right path or the wrong one? Let me know down in the comments below. I read every single one and I try to get back to a bunch of them. And if you haven't already done so, make sure to subscribe to the channel. I was checking out my numbers and I think half of the people who watch these videos aren't subscribed. So if you could subscribe, it'd be a huge help to the channel. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.